Robert Kiyosaki, the author of possibly the most bought personal finance book of all times, Rich Dad, Poor Dad, famously says the reason the poor and the middle classes struggle is that they buy liabilities that they think are assets. And what do I keep going on and on about? You need assets to create your freedom. Only assets can create your freedom. We got to fill up your asset drawer. What are assets? These different kinds of assets. You need to become an asset lover. But unfortunately, yes, as Robert says, most people think things like the bigger house, the bigger car, the yacht, the fancy holiday, the expensive schooling for the kids, that super expensive college education, and locks somebody in with a student loan for life, that those are assets, when most of those are just liabilities. They are just things that are going to drain and deplete your wealth, because all of the available money you have is spent either paying for them or maintaining those things. So it's super important we focus on know what an asset is. And so Robert also describes an asset as something that puts money back into your life. And go and watch a video on what is an asset, the difference between assets and liabilities, to get really clear on the difference between these two. And there are different kinds of assets. There are paper assets, also called intangible assets. The most common of these are stocks and shares, equities. Next is investment properties. Others are low input businesses. So again, there's a super cool video on these different asset classes and also how to design a portfolio in the investment pyramid. But in today's videos, I want to dive deeper into the stock market, stocks and shares, equities, what they are, and some stock market basics. So first off, what is a share? What is a stock? So there are amazing businesses all around the world that you can become a shareholder of. You can become an owner of that business by owning a share or a stock in that company. Now, there are two primary ways you can own shares. One are called publicly listed and one are privately listed, or private companies. Now, when I'm talking about investing in the stock market, generally we're talking about publicly listed companies. So a company will decide to raise finance for the company so it can grow and it can invest in itself by listing or offering a share of that company to the public. And so these become publicly listed or publicly available shares that the likes of you and I can buy, and we then own a bit of that company. So a company sells off some of its holdings, a portion of that company, to the likes of you and me and what are called institutional investors. Your big institutions, the pension funds, the retirement funds that invest in the stock market. So really, when you're investing in the stock market, you're actually becoming a business owner. You own a share in great companies. And you can, through straightforward, simple mechanisms, through funds like index trackers, you can own a slice of hundreds of great companies all around the world, right from the US to China to India to the UK, the developed world, the emerging world, and all from the comfort of your home. And whatever country you're in, you can get access to that. So it is a super, super, super sexy asset class. And by owning a slice of that business, you benefit from it in terms of your wealth by both the income and the profit that company makes and by the growth in the value. So remember, assets create your wealth for you in two ways: income and capital growth. In terms of shares, that income is called dividends. Dividends are paid out where companies have made a profit and they choose to distribute that profit to their shareholders in the form of dividends. So if you look at the fund fact sheet, or if you look at a company prospectus, the share prospectus, you can see what is the current dividend yield, and that just tells you what is the income that those shares are generating. And the other is the growth in value. So, as I said, there are different kinds of stocks. There's private stock or private shares. So that's if somebody owns a company, like I've got a company, if I wanted to sell some shares in the Welsh Chef to somebody else, that would be a private deal. And that's not available to every investor. And you can actually get private holdings in different private companies, which can sometimes be very lucrative, but they tend to be far less liquid because you've got a smaller pool of who you can sell those shares to. So we're talking about listed versus private companies. You also get two other forms of shares, and they are called common stocks and preferred or preference shares. Common shares are where you benefit, is the most common form that you get. And these are where shareholders are given the right to vote as a shareholder in the annual sort of shareholder meetings, and they have the right to collect dividends. Preference shares generally do not have the right to vote as a shareholder, but they have a higher ranking in terms of if that company were to go bankrupt, they would get paid out first. They also have the right to earnings at a higher preference, so they get paid out first. So sometimes you can also have a fund in just what are called preference shares or preferred stock, and which can have higher liquidity, but often the overall return on the difference between preference shares and common stock is common stock tends to have a higher historical growth or return on investment over time. So they tend to outperform the preference shares. So that's the kinds of shares you can hold. And so how do stocks trade? Well, they trade on stock exchanges, on stock markets. So a stock market is just like a farmer's market. So imagine you go off to your local farmer's market, and farmers have brought their produce from all over, and you can go to the market and you can buy some tomatoes, you can buy some bananas, you can buy some beautiful cabbages. And the marketplace is where you buy that. The marketplace doesn't own that. It's just a place where the produce from the farmers can be exchanged to you, and that is where the exchange of money can be made for that produce. Well, in the case of your stocks and shares in companies, that produce is the share, is that stock in that company. And this happens at these exchanges. Now, there are actually physical exchanges around the world. Some of the most well-known ones are the New York Stock Exchange, where you have that big statue of the bull and the bear in front of it. You have the London Stock Exchange, which is called the FTSE. You have the big stock exchange in France and in Germany and in Hong Kong. In Johannesburg, there's a physical stock exchange where there's a floor. In Australia. So some are actual physical buildings where you see in those movies like The Wolf of Wall Street, crazy trading going on. Now these days, very little trading actually happens on stock market floors where you have the buying and selling like at a crazy farmer's market. Most of it happens digitally. But in addition to those kind of exchanges, you also have something called over-the-counter exchanges. So the NASDAQ is the biggest over-the-counter exchange, where this is where technology shares are listed and bought and sold. So if something is listed on a stock exchange, that just means which exchange or which market are those particular shares can they be bought and sold. So for some very big companies, they might be listed on more than one stock exchange. Medium to other and to smaller companies would only typically be listed on one stock exchange, but you can buy them from all over the world. So that is where they are bought and sold. And so you need to have this stock broker or the stock exchange where the buying and selling happens, but you need to have somebody who facilitates that. So imagine at the farmer's market, you could use a trust mechanism where maybe the bananas are just shoved on a table and a price, and you take your bananas and you just put your money in a box and that exchange happens. Well, usually there's somebody there to facilitate the exchange. And in the stock market world, that is called the stockbroker. Now, the bad old days before the advent of technology, that had to be a physical person. And there are still physical stockbrokers. There's actually a person that you can speak to and go, okay, I want to buy this, stocks in these, or I want you to sell those shares. And they will go and facilitate the actual exchange. They have a license and they act as the broker, the trust broker, to take the stocks from the company and take your money and do the exchange. So a bit like in real estate, you have a conveyancer or an escrow that does the exchange and makes sure that it's all fair, nobody cheats somebody in that exchange, and that's what a stockbroker is. But the juicy, amazing thing is with the advent of technology, this is the asset class that technology really benefited first, because you had the advent of technology or computers being able to do that exchange. And so you have online brokers platforms, sometimes called discount, brokerage platforms, which still act as that exchange. And so they hook into stock markets and they give you an opportunity so you can go on to your online broker and say, I want to buy X number of units or X number of shares in this index tracker fund or in that specific equity, that specific company, and you give your offer, so that's your bid, and that computer links it up with other people who are saying they want to sell their shares in that fund or in that specific company, and it matches the two, and you've got an offer and a bid. Offer is the seller, a bid is your purchase. It links those two, and voila, the exchange has happened. And so that is just where the transfer happens. So what makes the price in those stock market prices change? Well, over the long term, it's actually the value of those underlying assets. How successful are those companies? Are they able to grow their earnings? Are they able to utilize their capital well? Do they have sustainability? So the long-term trends of shares in an individual company will typically be based on their performance, their ability to give a higher return on investment for shareholders and grow in value. But in the short term, the movement of stock market prices is supply and demand, largely dictated by emotional happenings and news, which is really important why you don't let that bother you. Unless you're a day trader looking at making money by the trade, not by the underlying asset, but what is the difference between those sales, so that's trading. If you're an investor, you're interested in owning the underlying companies, and you really don't give a damn about the ups and downs of the daily price changes or the weekly price changes or the monthly price changes, which why it is so important you put in place a regular investment strategy. So you want to go and watch the video on index trackers and how to be successful with regular investing, putting that in place so you benefit from this thing called cost averaging, and you don't let the ups and downs of the market scare the bejeebies out of you and distract you from your strategy. So that is it. There is Stock Market 101, understanding what shares are and how to invest in them and why you want them. So I'm Ann Wilson. If you're watching this anywhere over than at thewealthchef.com, head on over there. And I'd love to know in the comments below, are you already a stock market investor? And here's a little spoiler alert. If you have any kind of retirement funding, savings, pension, 401k, superannuation, if you invested in a fund scheme where you're contributing into some kind of mutual funds or unit trusts, you are a stock market investor. So important to know. And that is an asset class that you want working for you. So remember, assets create your freedom, not you. But you are the one that needs to get those assets working hard for you. So until next time, just enjoy being an asset lover.